All right. So first, in the last session, we were talking about the basics. You can say introduction of market profile. We were talking about the basic jargon that intellectual people like to use to sound smart, and these are basic things. And once you get to know them, then they are like pretty much easy stuff. So I'm hoping that all of you have gone through the first video. If you haven't, then let me quickly guide you that where you can access it. So in YouTube, just type GUI Trading. That's my YouTube channel. Oh, we got 80 subscribers, and here it is.
Yes.
So here, okay. So here you can watch it, and then you can refer to this today's session again. Acha. So since every time market from open to close, it makes a typical pattern, and those patterns are repeated over a period of time. So a certain type of price behavior or participants behavior is visible in the market, and many times those behaviors are repetitive. So many times price structure, or you can say the market profile structure, it is repetitive. So it makes sense to categorize them. And once we categorize them, and then we study what happens next day after certain type of category of profile has taken place. And after that, let's say there's some letter not nomination nomenclature goes like some B profile, some D profile, P profile, something like that. So let's say let's not bother about those nomenclature as of now. Certain type of profile, let's say D profile is formed, and if we can identify all those D type profiles in our market profile chart, and if we study what happened next day, that becomes our backtesting. So with this backtesting of historical data, we can pretty much gauge with a certain percentage of accuracy what is going to happen next day. So let's say if we found 100 D profiles, and we found that whatever happened on that day or whatever was happening previous day, it followed the next day. And it happened something like 80% of the time. So out of 100 days, 80 days, market continued to trend in the same direction. So it can be labeled as, if a D profile is formed, it can be labeled as a certain pause in the trend. And once D profile gets over, once the trading activity of that particular day gets over, then we can pretty much, with 80% confidence, we can deduce that next day trend is going to continue. That's how basically this study of market profile lets you understand what is going to happen on the next day. So with, of course, certain with the chance of with the probability, of course. So categorizing the daily market activity or weekly or monthly or yearly market activity, and then you can say putting them in classes of profile, putting them in a particular structure makes sense to categorize the market. And it also makes sense to study the market, because once you know D profile is formed, you know with 80% conviction that next day trend is going to continue. And this is an hypothetical example. I'm not saying that every time a D profile is formed, the trend is going to continue. I'm just saying, if once you know the category and with the backtesting, you can know with what percentage accuracy you can predict what is going to happen next day. And in the same example, let's say D profile formed, and prior to that, market was in a downtrend. So let me try to draw it. Let's say market was in a downtrend, then D profile formed, and our backtesting result says that 80% of time, this trend is going to continue on the next day. So this becomes our reference line. We know that we anytime market next day, basically, if market tries to come close to this line, we are supposed to short with 80% conviction rate. Okay. Suppose next day, if market happens to open here, And as per our study of market profile, we know that next day should be a downtrend day. So even if market gaps up, that means you were trying to sell at, let's say, 100 rupees, and now you get to sell at 110 rupees. So you go double sell here, because if market gaps up without any fundamental change in the market, then you can pretty much expect that this is going to go down. If market opens here, again, you still have 80% conviction to go for the price to go down. If market opens here, then it has already gone through this much of a down move. Though price did not trade, but yeah, price adjusted to itself. Like here in price action, we treat this as invisible candle. So as the gap down increases, our conviction of downtrend decreases. So basically, at this particular point, we'll be careful. At this particular point, we'll be extra careful. And at this particular point, we will not take it. So based on these, basically, we can deduce pretty much that how we can trade. So currently today, we are not going to delve into how to trade this. This is just the covering of the basics, and this is the final lecture on the basics. And from the next session onwards, we will start to discuss how to trade this. So first is normal day, and the name is confusing, though it is named as a normal day, but it is not normal at all. So it does not happen pretty often. And key characteristic of identifying a normal day is a wide initial balance, IB. So IB is the range of, let's say, if we trade Bank Nifty. So IB is the range of Bank Nifty in first 1 hour of trading session. So that's your IB. And IB is generally wide. So wide IB means Bank Nifty has a typical average daily move. From historical data, from last 5 years data, last 3 years data, you can find out what is that average range. And if that whole range is covered in first 1 hour, then probability of Bank Nifty making a further move in same direction gets reduced. Let's say average range is 1.5%. Bank Nifty on an average daily basis moves 1.5%. And if in the opening 2 candles or in first 1 hour, if Bank Nifty has already moved by 1.5%, then you pretty much, you can guess with the increased conviction that Bank Nifty is going to stay in that tight range, in that range of IB. So that's how basically this identification of normal day goes. And though it's called normal day, but it's not very frequent. And this IB, this wide IB, is caused by early entry of other time frame participant. This is a term used by authors of market profile, the people who have wrote books on it. And other time frame participant means the big buyer or seller. In other words, smart money, those investment banks, etc., people with big pockets. So the people with ability to move the market, they are referred to as other time frame participant. Okay, so whenever you hear this or OTF participant or other time frame participant, by default assume that they're talking about the market movers, big buyers and big sellers. So generally, big buyer and big seller waits for a certain time, 45 minutes, 1 hour, for the initial activity to cool down, and then he starts to make the move. Sometimes he may be in a hurry, and sometimes as soon as market opens, these people also enter. And whenever a big buyer or big seller enters in the market, a big candle will be formed in the morning. So that's why the initial range, the initial balance, you can say, gets widened. And that's how the characteristic of normal day is defined. Achha. Now this point is to be noted. These 3 points, they are same from the previous slide. And this, whenever a normal day takes place, high POP is probability of profitability. You can say conviction rate rather. So you have high chance, high probability to trade along the recent market activity. The same example that I was talking about. If market was in a downtrend and a normal day is happening, let's say you got a wide IB. This was the previous day and you got a wide IB. So This line means in this IB, since market is going to be range bound, and it's a good chance that market is going to be range bound. So you should be entering along the recent market activity, and recent market activity was downtrend. So it is telling us that you should be looking for the short trades. It does not mean that you cannot look for buy trades. You can, of course, but your RR, your conviction, your accuracy, it will be low. Overall, your confidence level should be low on the going on the trades against the trend. So recent market activity, if it was on the downside, then look for the shorts in the range. Whenever market tries to go up, short here, short here, short here, your stop loss will be low and your success rate will be high. So this is what it is saying, that high probability trades will occur along the recent market activity. And for the timing, you know, this big picture, basically what is happening overall in the economy, etc., etc. So that comes later. So this is an example of a typical standard normal day. So this is a profile of 30 June. And as you can see, if you look at the left-hand side, this horizontal yellow line and this bottom horizontal yellow line. This yellow period is your IB, initial balance, first 1 hour of activity. And if you look at the right-hand side in the candlesticks chart, this A period, these letters A, from open, this is O basically, O for open, from O to A up to this point, 33612. This is the high of the A period, first 30-minute high. And then the B period goes up and then comes down. And this marks for a high IB. Now let's find out. I mean, I could have elongated this profile to make it bigger, to make it look bigger. So let's look at the chart. 30 of the June. What happened? Okay, so 30-minute, and we need to go to 30th of June. Here. This is the profile. And even if you look in the vicinity and surroundings, then this is a pretty big candle. And if you look at the range, it's 1.42%. And average move by Bank Nifty is 1.5%. That I have calculated using ATR method. So average move of Bank Nifty is 1.5%. And you can say almost the whole move got over in the first two candles. So this does denote a wide IB. So recent market activity is a downtrend. So every time market comes up, though you will not get much of the opportunities, probably one here at 12:15, another probably here at 1:45 or 2:15, and you may not get much trades, but yeah, both trades would give you profit. So go along the trend, and in the IB, you can have an increased conviction that market is going to be sideways. So go with the recent trend. So that is how a normal day looks like. And as you can see, okay, starting from 20 June to 12 July, something like 3 weeks and more than 3 weeks. So how many normal days are there? This could be 1, 2, only 2. And if people argue that this is not a normal day, I would not argue with them. I mean, by definition, by strict definition, it is not a very wide IB. I mean, even after moving by almost 1%, still 0.5% of volatility is left. So I would not argue with them. If you look from here, you will come close to 1.5%. So those people who are aware of price action concepts, they can relate pretty much that from previous close to this high, this is 1.5%, roughly 1.5%. That is average volatility, and move is over. Day is over. Day's move is over, kind of. So recent market activity is not decisive. If you say it's upside, I mean, if you say that market has bottomed out, then look for the buying opportunities. If you think market is in a downtrend, look for the shorting opportunities. So whatever criteria you decide about the recent market activity, go along with that, but try not to trade on the both sides. That's what I'm trying to convey. Okay, so that's how a normal day looks like. Now there is a normal variation of normal day. I don't know what is the logic behind this, but only one thing I can relate is if we go back, normal day is not frequent. So there could be a version which is more frequent. So probably that version is named as normal variation. So the only thing, a few things that are different from normal day. Okay, let's ignore this. On normal day, IB is wide and big buyer or big seller enters early. That's all. These 2 points stand out. Here, IB is wide, but it is less wide. Less as compared to what? As compared to pure normal day. Okay, so like in a pure normal day, the IB was coming out in the recent example, it was coming out 1.45%. So probably in this case, it would be like 1%, 0.8%, something like that. So it will be less wide as compared to normal day. And this is caused by a slightly delayed entry of the other time frame participant, the big player, basically. On the normal day, the other time frame participant, basically big buyer or seller, enters right at the open or in the first few minutes of the open. In this case, he opens slightly delayed. His entry is slightly delayed. And since his entry is slightly delayed and IB is less wide, so there is a chance that range extension takes place. And good chance, basically. And if let's say other time frame person, big seller is there, then somewhere big buyer will also be there. So if in initial hours, sellers push the price down, then the later time or whenever the price is reached, the value is reached, buyer steps in. And this buyer then these two start to fight. Seller lose the interest because the price has already moved down. And for buyer, he is excited because price reached his value area. So he'll start to buy. So this buyer stops the price. And this stopping point is usually outside the IB, initial balance. And range extension takes place. And this is an observation. It's not a rule. It's an observation. So how does this look like? This is its profile. You see here, this yellow period, A and B period is the yellow period. So high and low defines your IB. Then price is pushed down by the seller, and then some buyer stepped in, and then buyer absorbed all the supply and stabilized the price. So the value area, this gray box that you are seeing, a bracket you are seeing, it is placed outside with the IB. And if seller was active, this value area could be placed like this also, but it will be in the lower half. Okay, I mean it will not be key. This is IB and value area is also placed like this. This will not happen. So initially seller was active and he pushed the price down, and then buyer stepped in. And why buyer stepped in? Because probably in this zone, the buyer, his model was suggesting that this is the fair value of the Bank Nifty. So anytime the price goes below this value, he will buy it. Simple. So he will continue to buy, and seller will not be that aggressive in this area because seller has already pushed the price down. As the price continues to move in favor, his conviction drops. And as price comes towards the buyer, his conviction increases. And anytime price, let's say if this was the value area, anytime price is below the value area or this value price, buyer will be happy to buy. So he buys aggressively and he absorbs the less dominant supply of the seller. So the price stabilizes and buying, selling takes place, and the big buyer is strong, big enough to absorb all the supply of retailers and local players. So price stabilizes here. So this is typically how a normal variation of normal day looks like. This is normal variation because this happens quite frequently as compared to the normal day. So this profile represents 4th of August. Let's see. Let me also keep showing you the profiles. So we are talking about Bank Nifty and daily, yes, and dates we are in August. Come on. Okay. This is the profile basically. And this is 4th of August. So let's go here. Where is 4th of August? This is 4th of August. So initially, if you look from here, so initially, yeah, buying and selling between the retailers, between local players is taking place. And in the C period, as you see, big player entered and he pushed the price down. See. Let me split it. Yeah, this is the C player. He pushed the price down. Then the D period, he pushed the price further down. Then in the E period, he pushed the price maximum. There was no buyers left and there was nobody to stop the seller. So he just went crazy and he pushed the price as much as he could. Then in F period, someone stepped in and he pushed the price back. Then in G period, he pushed it further back. Then in H period, he pushed it further back. Then here they started fighting, both buyers and sellers and retailers. They all started to fight and price consolidated here. So this is typically what the structure looks like in market profile. In candlesticks, it's visible here. This is the A period, B period. This is 30-minute chart, same as market profile. So A and B period, nothing much happened. If you look at the range, then range is hardly 0.5%. So it's a small range. So you can pretty much guess that small IB, that means small base can be easily toppled. So it got toppled very easily, but it got rejected from a price. And this reaction, this 1145 candle, where my crosshair is, or this line is, this gave away everything about the day. You might think, did we need to wait for this confirmation? Yes. If seller was this dominant and this 1115 candle was a big enough candle that buyers are not there. But in this candle, buyers stepped in. And so this candle gave away everything about the rest of the day. So you might say, man, we missed this recovery, and now we get to trade only this. So yeah, the contra traders basically and pure price action traders, they look for these kind of opportunities. And you just need to find 1 or 2 right trades, even if it means to wait for the whole day. And you will get plenty of opportunities to make money here. Those who are trend followers, and there are many techniques like open drive, there is breakout and many things. So they could have used it to enjoy this fall. And sideways traders, yeah, they will make money here. So the difference between a normal day and normal variation of normal day is, first is IB. If you look at the 30 June, this is 30 June. So IB is large. So IB is large. That is the base which provides stability to the price. That is large. So large stability provider means price is going to be stable. And here, small base easily toppled and then buyer to control later in the later part. And the value area was formed outside the initial balance. So this is the normal variation. It takes place quite often. Now comes the trend day. Acha. The first identification of trend day is small IB. Now, here is a small IB. Basically, from this point onwards, the life of a market profile trader starts to become little difficult, because they find it hard ki how much is a small IB and how much is a less wide IB. So you pick the instrument that you like to trade, and then you backtest this. Then you get a fair idea that how small is small enough, how wide is wide enough, and let's say 0.5% is small enough, 1.5% is wide enough. So somewhere between 0.5 to 1.5 will be your less wide or wider than IB, wider than the trend day, like that. So in other words, you can say that the trend day, for trend day, standard trend day, IB is very, very small. Okay. And it's very small. And since it's very small, then the base is very small, then the factor which stabilizes the price is very small. If stabilizer factor is very small, then it can easily be toppled. Hence, price breaks out. And as the price breaks out, this gives away the trend day. We talk about, like, let's say we are talking about downtrend. Currently, my mind is totally occupied with the downtrend because of upcoming recession and all. So a trend day will a trend day will typically look like this. A period high will not be violated by B period high. B period high will not be violated by C period high. C period high will not be violated by D period high, and D period high will not be violated by E period high, and E period high will not be violated by F period high. So previous candle high in a downtrend will not be violated by the subsequent candles. So the first two candles, they will give you a small IB, so you can anticipate a trend day. And as this thing is going on, you can be assured of, not certain, but yes, with a good chance, that trend is going to continue as long as the previous candle's high is not broken. So that is what is written here. That previous time periods opposite extreme. So in a downtrend, opposite extreme will be high. In an uptrend, opposite extreme will be the lows. So the opposite extremes are not violated. And as long as this holds true, trend holds true. As soon as this previous high is violated in downtrend, trend has stopped, or this trend day conditions are no longer valid. So you should be exiting your trend following systems and their trades. Acha. Directional confidence is evident throughout the day. If there is a trend day, if the whole day market was trending, this will become evident as long as previous candle highs are not being violated. So as long as previous candle highs are holding their place, you can be confident about the trade. And as long as it's going on, you can stay in the trade. You have no reasons to exit the trade. So this point is done. Other time frame, yeah. Since if market is trending throughout the day, market can only be moved by big players, other time frame participants. So the big players, if big players are the only person who can move the markets, and if market has traded unidirectionally in a single direction, that means the other time frame participant, the big buyer or seller, was active throughout the day from open to close. So other time frame player will be active throughout the day. How would we know this? We would know this by, okay, can I plus? No, I cannot. Okay. How would we know that previous time frame, bigger time frame, other time frame participant is active or not? We will know like this. As long as these previous candles highs are not being violated, we can be certain, not certain, we can be confident that other time frame player, big player is present. So we will be present. So that participant will add to our conviction, our confidence, and profile is thinner since price did not stay at a particular level for a longer period of time. So our market profile, it is relatively thin. It's you can say for a standard trend, it's thinnest. This does not hold any meaning. It's just an observation. It does not hold any meaning. The most ruthless thing about trend day is it does not retraces. It does not give you entry at all. I mean, you wait for a supply zone for a downtrend. If you wait for a supply zone, a good new supply zone is formed, but market is just keep on falling, falling, falling. It is not. It's relentlessly falling, not giving an entry at all. That's where FOMO kicks in. And once Bank Nifty has fallen, let's say by 2%, you already know that the meat of the move is over. Now market will be reversing or market will be continuing. There are big down candles, big red candles. So you're not finding confidence to enter on the long side. And since there are big down candles and market has already fallen by 2%, you're also not confident to enter on the sell side. So on these days, retailers or short-term, basically short time frame traders, they get butchered. And if we happen to look at our trade log, and if we pay close attention to the days where we lost our maximum money, apart from those expiry days, these were the days. Because trend went like in a fashion that we could not enter, and trend is not retracing. So there is no chance to enter opposite to the trend, contra side. So we need to be watchful. So identification of such days is important, because when you find such things happening, either enter with market order and go along with the trend. And somehow, if you are not confident enough to enter with the market order, simply sit out. At least do not go against the trend. And these are the characteristics that IB will be small and this point. So just two factors, and you can save yourself from bleeding lot of money. Simple. So identification of such days are very, very important. This is how a typical trend day looks like. On profile, you see that A profile, then B profile, slightly C. Here you see 3 letters, here 3 letters, here is 4, then 1, 2, 1, 2, 2, 3, 2, 1, 1, like that only. So there is no clear, you can say that there is no effective value area, reliable value area, because price did not stay at a one level for a longer period of time. Price relentlessly in one directional, unidirectionally, directionally kept on moving. And this happened on 30th of August. So let's see. 30th of August. Yeah, here it is. And next day was Ganesh Chaturthi, and the past 12 years, there was not a single day when market closed in red on an occasion of Ganesh Chaturthi. So, okay, that information now becomes useless until next year, but still. So on a trend day, this is your IB. This is your IB. Slightly more than half, not slightly more than, but yeah, greater than half of the IB, but still not compared to the whole IB. And how would we know that it is going to trend? First clue was here. Market broke out, did not retrace. And as soon as this candle closes, you can deploy any kind of trend following strategy. And you can enter at this candle or this candle or this candle. If you could not enter in these first 3 candles, then probably you just need to wait for the, you just watch the show and enjoy the trend. Simple, do not enter. So simple breakout strategy will work here. So identification of the IB and any previous low will not be violated. Let me show it. This is obvious, it is not being violated. Then this low not violated. Then next, then I'm talking about the same day, okay? Next, and then here, then here, then here, here, here. None of the lows are being violated. So this is a perfect example of the standard trend day. So whenever such days occur, just go crazy because you are in for a good ride. And on such days, you make your most money and you can simply wait out for the whole month or in some cases, whole quarter. All right, so that's how the trend days, standard trend days goes. So this profile, this thin profile will be visible to you at the end of the day. But yes, small IB and the previous lows being protected, that's your clear indication of a trend day. Next is a variation of trend day, which is double distribution, which is also referred to as B profile, B for Bombay. So profile generally looks like this. So let's say this is initial IB and price will break out and then some buyer will step in, and it will hold the price and the price will consolidate here. Now you might think that similar thing we saw here. Normal variation, IB, then price broke out of the IB and then it consolidated outside the IB. So could this also be a double distribution day? Let's see. There would be some difference, otherwise they would not bother to label it differently. So first thing is a very small IB. So probably what we saw in for the trend day, the IB will be smaller than that of trend day. New value area, this will be visible outside. So this is not useful. This will be evident at the day end. This is the key point, most important key point. The two values areas are separated by a single TPO. TPO are those letters ABC. So these two value areas will be separated by a single letter. So it means price was in a consolidation. Some news will occur. Some data macroeconomic data may get released and it will surprise the participants and hence price readjusts itself. So let's say price was here and suddenly some news came in, price kicked it down, and then the buyer stepped in because this was the point number one is the initial value line for the Bank Nifty. And after the news, the second point becomes the new value for the Bank Nifty. So whenever price goes below, buyer finds it attractive and pushes the price back up. Whenever it goes above, seller finds it attractive and he pushes the price back up. So here both buyers and sellers and local participants, that means us retailers, they participate and they exchange the trades and price consolidates here. And this range is usually not broken. The second range is usually not broken because price has already adjusted itself according to the news. So the two values areas, there will be a very, very, very sharp movement. So there may be a value area somewhere here, there may be a value area somewhere here, but they will be separated by a very, very, very thin TPO, by a single TPO, single letter. So that means in 1 30-minute candle will pass through this zone and it will never touch it again. So that's the sign of double distribution. And new trading range usually holds out throughout the day. So new trading range means this portion. Let me choose a different color. This portion. This is the new trading range and this does not break. So once the double distribution is happening because of a news, this will happen in case of certain news or macroeconomic data. So news or data that will surprise investors or traders or market participants, and that will cause this abrupt move. Apart from this news or data, there is nothing. So price will consolidate at the new value. Simple. So whenever price tries to go past, it will be pushed back up by a buyer, and that will give away the rest of the day. If this happens early in the day, you are in for a pretty much sideways movement throughout the day. If it happens pretty much late, there is nothing but you can do about it. So just wait out for the next day. Simple. So the difference between this double distribution and normal variation of normal day. On the double distribution, the IB is excessively small. So this might give you a hint of a trending day, but that small IB is because of the upcoming news or data. So the local participants, they are also not able to find any conviction. So they are trading very, very small. Then the data comes in, price goes outside the range and then consolidates there. And that range is not broken. And this is the key point. The two value areas are separated by a single TPO. Let's look at one example. So this happened on 22nd of March. Okay, so price basically, this is this yellow portion. So A period and B period, it's 22nd of March. Let's look at in a proper way. 22nd March. 22nd March. Okay, here it is. So price opened. Yellow portion is A period, B period, and then price consolidated there for a while. Then the G period, it tried to break down. Sorry, not break down, break out. H period, it actually did break out, and then I, J, K, L in subsequent periods, it's consolidated in the upper portion, and the value area and POC, etc. They were all not the POC, but the value area. Yes, it got shifted to the upside. How does this look on the candlesticks? So 22nd March. This is the 22nd March. So as you can see, price was initially consolidating. And let's check if there was anything on 22nd March. If I am able to find 22nd March, and this move happened on around 12 o'clock. So was there anything around 12 o'clock? Countries, Asia, Europe, and America. Achha, it will not choose all of them. Then India. Where the hell is China? Here it is. India, China, Brazil. Brazil is there. Okay. So 12, 12, 12, there is nothing. So let's look at there may be something at the European. (22nd March). There is nothing. I cannot see anything. So probably there was some news, and which I can find it, but that will be wastage of your time. So let's not bother about that. Let's just assume that there was some news and which caused the back tree to move up, and then it consolidated in the upper portion. And this does not qualify as a trend day. I mean, if you want to say, was it a trend day? So it wasn't. This low protected, but this low got violated here. So this is not a trend day, but this will be counted as the double distribution day. So after breaking out in 1 hour, it moved how much? It moved by 2.3%, 2.3% roughly. So this 2.3% move would be caused, intraday move would be caused by some data or some economic release or news. So that's why this happened. And then it consolidated. The move did not last. So that's how basically a double distribution day looks like. So it's very small IB, and then price breaks out in a hurry because of some news, and those two TPOs, they are separated by a single file, or not two TPOs, I beg your pardon. Those two consolidations or value areas, they are separated by a single TPO, single letter file. This H period here you can see. Okay, so this is separated by a single file, but this is the key characteristic, and then it stays there in the upper or lower half. Then there is a non-trend day. Acha, so far, before I proceed, if any of you have any doubt, so you can unmute yourself, and if you have any doubt, please ask.
No questions, Sanjeev. I'll watch this video from the beginning again because in between I had some disturbance at home. So
No problem, no problem. All right, then let's proceed. Okay, so we started with normal day, then normal variation of normal day, then trend day, standard trend day, then double distribution variation of trend day, then non-trend day. So everything that is there in trend day, it will not be there in the non-trend day. So IB is narrow, but it is not too narrow. And there is no range extension in the trending day. Range extension will take place. Either it's a standard trending day or it's double distribution. So range extension takes place. IB range is extended multiple times. And here no range extension takes place. And you can avoid these days trading these days because just before a big data or big news event, new event or news event or holiday, generally market tends to fall in this category. Generally, not always. Like 30th of August, we just checked. 31st August was a market holiday because of Ganesh Chaturthi, but 30th of August happened to be a trending day. Okay, so everything is probable, nothing is certain. So non-trend day, they usually occur before release of a big macro data or big event or a public holiday, and it's just that day is basically used to get rid of unnecessary positions and to reduce the exposure, reduce the risk, and trades, they do not take place in any direction. There is no trend at all and no range extension. So these are the days in which you can avoid trading basically. If now a question might arise that if range, this IB is narrow, how would we know that it's going to be a trending day or it's going to be a non-trending day? Because both for trending day and non-trending day, the first requirement is IB should be low. So your answer will appear if IB is breaking or not. If market is not breaking out of IB, then you are pretty much in for a non-trend day. And if market breaks IB and stays outside the IB, then you are pretty much in for a trend day. So the initial conditions, yeah, they kind of look same, but the subsequent market behavior will reveal whether the market, the price is, the day is going to be the trend day, standard trend day, or whether it is going to be the non-trending. All right. So if IB is breaking, you are in for a trend day. And if IB is not breaking, even if it breaks out but comes back in, then you are pretty much in for a non-trend day. So range becomes extremely small, so you can pretty much avoid trading such days. So non-trend days, as you can see, the IB and then tries to breaks out, but then stays in the, as you can see, the tight range. So this is 10th of August. Let's see. 10th of August. This is it. So the total range is how much? 38196 and 38436. So it's roughly 240 points. So that's pretty less for Bank Nifty. Though there will be trading opportunities, but 10th of August, let's see. Opportunities will always be there, but we can always choose not to trade them. So this is what a typical 10th of August looks like. Absolutely nothing. If like IB, if they try to break IB, like they tried to break it in this particular candle, but they could not sustain. So yeah, you could have gone short here, and it did not reach any time throughout the day. So even if you shorted here, how many points would you get? Let's say if you were good enough to short at here, the maximum points you will get is 100 points, 120 points. And if you wait for 1, 2, 3, 4, 5, 6, 3 hours, you will get 180 points. And in those 3 hours, your option price, I don't know how much it will give. So for me, it's not worth my time. So I will avoid such days. I'm not saying you should do the same. For scalpers, a master scalper will trade this, everything. They will make money probably. And but I would avoid such days. So non-trend day, there is no conviction in direction. IB is small, but even though that small IB is not broken, market tries to break it, but it comes back in. So lack of conviction, even in this small IB. So that's your non-trend day. Then there is a neutral day. Now you might want to scratch your head. Okay, now what is the difference between this non-trend day and neutral day? Isn't they both of them are same? Isn't non-trend day and neutral day same? So apparently, definition-wise, it is not same. When these occur, first the key point is IB is not narrow. IB is between a trend day and a normal day. So let's say after backtesting, you found 100 trending days and 100 non-trending days, normal days. And let's say for trending days, average IB is 0.7%. And for normal day, average IB is 1.5%. So somewhere between 1.1, 1.2, like that, you can declare that it could be a neutral day. And Baki rest, it is evident. Like if it's going to be a neutral day or non-trending day, then both buyers and sellers are big buyers and big sellers. Other time frame participants, they are active, and this happens usually when the seller and buyer, their fair values of Bank Nifty, they are not far apart. Let's say, for example, 38,100 is the sell value for one, and 38,000 is the buy value for one. So their buy and sell values or fair values, they are just 100 points apart. So every time market tries to go above 38,100, seller will push it down. Every time market goes below 38,000, buyer will push it up. So what I'm trying to say is, this is upper range, this is lower range. Whenever price tries to go outside, seller will push it down. And whenever price tries to go down, buyer will push it up. And this keeps on happening. So that's how a neutral day takes place. So in a non-trend day and in a neutral day is tradable because IB is not very small. So you might get 100, 150 points move, tradable moves. Like in the previous case, here you might also say that there was 180 points move. But I'm assuming that we are not godly enough to short here and buy here. Okay, so probably we'll capture half of it or 1/3 of it. So 1/3 of it will be 60 points of Bank Nifty. That will yield into somewhere 35 to 40 points, depending on what strike you choose from like in the money options. So for 45 and 35, 40 points, I would rather not waste my whole day. On neutral day, IB is not very small, so you might get opportunities. So neutral day is tradable, and definition-wise, it is categorized into ways. If the day closes in the middle of the range, it is called neutral center day, worthless. And if the day closes on extremes for the day, neutral day is called neutral extreme day. This is beneficial because you can say theoretically, let's say, this is the range and the market bought and it closed here. Then theoretically, it is moral win for the buyer. That's what the book says. I do not find it useful because I don't know what's moral and ethical in this cutthroat market. But yeah, that's what the theory says. Okay, this is moral victory for the buyers. Probably it might strengthen their bullish sentiment. And apart from this, there is nothing evident. So range did not break. That is what evident. So both the buyers and sellers, they did not push the price in any one direction. So price consolidated. So there is no definite direction to the market. Even if in this range it closed at the extremes, it does not make much of a difference as compared to if it closed in the midpoint. So these two are just definitions. And after backtesting, yeah, you might find that there is a small change, but it will be very, very small. But throughout the day, yes, it can be traded as compared to a non-trend day, because non-trend day is kind of worthless, holds nothing. A neutral day, you can trade for the both directions. And this is the conviction rate. So directional conviction, directional confidence. So on non-trend day, basically lowest conviction. So biggest recommendation, strong recommendation would be to avoid. Normal, slightly higher. Neutral center, slightly more higher. Normal variation of a normal day, more. Neutral extreme has greater directional confidence. So I would like to take back what I just said. If market is neutral and it closed at the extreme, directional confidence is high. Not very high, but it is just below those two trending days. So you can say that if market is neutral, it's not non-trending, it's neutral. So IB is decent, it's not big enough, it's not small enough. IB is there, it's significant. And then market, the price closed at the extremes. Then it is the third highest directional conviction. So, and then the next highest is the double distribution that your B-shaped profile, and trend is just simple market goes in a straight line or falls in a straight line. So that's how basically this directional conviction goes. So I would always say to trade, if you want to make most money, then look for these three: trending, double distribution trending, and neutral extreme. You will not make money on the same day. You will not make at least big money on the same day. But since directional conviction is high, so next day you will make money going along with the direction. And this normal variation and neutral center, they are for sideways market. These to avoid. Normal is anyways, it's rare, it's not too frequent, and non-trend is strictly avoid. You don't need to be wasting your time sitting in front of the computer. So out of 7, these 5, they are tradable, and these 3 are the days which take care of your losses. And if you happen to be on the right side on such days, market rewards you in a big way, just like on 30th of August. So it just went 3.5%, I think, that day. And if you are on the right side, you make big money on that day. So that's all. That's all for today.